Hey everyone, I hope you all are doing really well. So finally starting with the management accounting revision sessions. So let me just share my screen and tell you which all topics will be covered in this particular session for the revision of management accounting. So here you can see the screen in front of me, and I'll be taking 5 chapters in this particular study unit. If you can see in here, we'll be covering chapter 1, which is accounting for management, and then we'll be jumping to a chapter 4, cost classification, then accounting for materials, accounting for labor, accounting for overheads. These are the 5 topics which we will be covering up today, and the further topics will be covered in the upcoming sessions. In total, there will be 4 sessions. We'll be going through the content overview of these topics in this particular session. So if that's something which you are looking out for and you're going to give your examination soon, then you guys need to watch this long session till the end, and also wait for the other sessions to come up so that you can cover up your all syllabus of management accounting in these sessions itself. You can see all the chapters in front of you. I'm going to teach all these chapters, overview of all these chapters. If possible, we'll be doing through few test your understandings also. In short, what all can come in your examination, these all will be covered in these particular sessions. If you are having any doubts, any questions as such, you can put it down in the chat section, or you can put it down in the comment section below. Just to share with you that you will be getting 35 2-mark questions, and you will be getting 3 questions which are 10 mark each. That's the examination pattern which you're going to get. It's going to be a 2-hour examination, and maximum you can give it at your home or wherever you want to, because remote examination is available in here. So let's get started with the first topic, which is accounting for management. Now, there are few basic things which we are going to get started with. First is data and information. What is the data and what is an information? See, a data is something which is raw, which is unprocessed. Like suppose there's a person standing. Okay, there's a person standing. Now, who is that person? What is that name of person? What are the details of that particular person? That's information. There's a person, that's data. There are 100 viewers viewing this particular session. Who are those people? What do they do? That's information. So a data is something which is raw. A data, when processed, becomes information. So that's a basic info, the basic understanding about data information. And you guys also need to have this clarity, because you can get a question in the examination. Then comes, what are the good attributes of information? What are the attributes of good information? Sorry. What are the attributes of good information? Now, attributes of good information: it is accurate, it is complete, it is competitive, it is cost effective, it is understandable, it is relevant, it is cost effective, timely, easy to use. These are the things which are stating that these are the these are the attributes of good information. So if you just see in here, they talk about that information should be accurate, information should be complete, it should not be half available. If it is complete, then that is an attribute of a good information. It should be cost effective also. The information which you get, it should be cost effective towards your business in which you're going to take a decision. It should be effective. See, cost benefit analysis is really important. The cost which you're going to levy on that particular data, the cost which you're going to levy to get that particular data, should be enough to give you much more benefit than that particular cost. If that's the case, then you would be like, okay, let's go, because that's going to be cost effective. Then you can see in here that data should be understandable, it should be relevant, it should be authoritative, it should be timely, and it should be easy to use. Now, what do you mean by understandable data? So it's something, understandable information. So that's something which is going to be useful for your business. It should not be in some words which you cannot understand and your team cannot understand. If you and your team can understand what information it is and act accordingly upon it, then that's 100% understandable. And is that relevant? Is that information relevant to you or not? That matters a lot. Like suppose there's a business which you want to market or which you want to promote. So you need to make sure that you promote it on the right platform. You just don't promote it in an irrelevant platform to an irrelevant audience. If you do that, then you have no business coming out of it. Your information should be authoritative. You should be able to take reliable decisions based on it, and it should be available on time, and you should be able to use it easily. So these are few attributes of good information. Moving forward, so data, information, knowledge, and wisdom. Data is something which is completely raw, and if it is processed, it becomes information. And if information is again further processed or further remembered, which you cannot forget, it becomes knowledge. And knowledge further practiced upon again and again, again and again, again and again, it becomes your wisdom. So that's what is the process of this: data, information, knowledge, and wisdom. Okay. So moving forward are your mission statements of organization. See, how do you need to make your mission statement? See, it should go towards like purpose, strategy, policies, and culture and values. These four things should be there in your statement. So then it becomes your mission statement. If you just see in here that Kaplan's mission statement is this. Let me just read one mission statement. Honda, maintaining a global viewpoint. That's the purpose. We are dedicated to supplying products of the highest quality. Products of the highest quality they want to supply. That's their strategy. And then next you see here, yet at a reasonable price for worldwide customer satisfaction. Yes, at a reasonable price for worldwide satisfaction. That is their policies and culture through which they are going to create value through customer satisfaction. So these all stuff put together, made together, and delivered in a proper statement, it becomes your mission statement. See, normally when you have a mission statement, like Nike says, just do it. That's not a mission statement, that's a slogan, okay, attached to it. Mission statement is something which is a further detailed thing so that employees, workers, everyone can have a shared vision also with it if they have a proper mission statement. I hope that I am a bit fast only so that we can cover up 5 chapters in this session itself. So then see here, managerial process, planning, decision making, and control. When you see planning, decision making, control, why is this camera stopping us in between? Let me just, okay. So if you just see in here, what do you do in planning? You set your objectives that you want to achieve so and so things. And then you make a decision, you implement that particular decision that in this manner, I'm going to do it. And further, it goes on like gather information and see whether whatever you planned, is it going according to that plan or not? So this is overall a basic introduction of management accounting, that these are the works to be done. If you just see in here, we have not talked about that what type of accounting we have to do. It's more of how are we going to manage this particular organization. In fact, planning should always be SMART. Now, SMART means there is an abbreviation for it. SMART is specific, measurable, attainable, relevant, and timely. Okay, attainable, achievable, relevant, and timely. These are the things which are an attribute of a good plan, of a good goal which you have. It should be specific that, okay, this is what we need to achieve. It should be measurable that, okay, in this particular time or in this particular framework, we should be completing it. And it should also be achievable, attainable, and it should be relevant towards the objectives which you have. And it should be timed in such a format that you achieve it within time and it does not take more time for you to complete it. So that's smart planning. Then in decision making, most of the places, like suppose if you just see in here, there are many examples which we talk about decision making. It's really a very important factor which you need to consider in an organization. What type of products are you going to sell? In which market you are going to sell it? How are you going to price that particular product? How are you going to cost that particular product? It's really important for an organization to understand. In fact, to take a career decision also, it's really important for you to take a decision, and that's somewhere where you seek advices of people. So it's fine that you seek advice of people, but what you have to do, it should be like, yes, you completely back it up, and yes, I wanted to do that, and go ahead with that particular thing in your organization. Decision making, after decision making, you should not be like, that's not my decision, someone said me, someone advised me to do it, and that's why I'm doing it, and that's why I'm facing the problem, it's not my mistake. So that is not that's not a person who is a leader. That's not a person who is a decision maker, because a decision maker, a leader, takes responsibility, takes authority in making a decision or doing anything forward. And then moving forward is towards your control. Like once you've made the decision, once you have planned what you want to achieve, you need to make sure that it falls in line, it falls in control. Okay, if it falls in control, then only you can move further forward. You plan, you make a decision, and then you try achieving that by proper control measures. If you don't have those right control measures in the organization, then you will not be able to do that. For example, if you want to get started with some particular business idea, you want to get started with any business idea, what's required first is plan. That how are you going to do it? How's the business model which you're going to make? Now, how is the business model which you're going to make? That you need to sit down with scratching your maybe you're scratching your head, or you're just scribbling it down that okay, this is how our customer should be, this is how we need to place our product in front of him so that he should take it, this is how we should design our product so that it is more viable for the customer, this is the time at which we need to market it, this is the cost at which we need to cost it and price it in the market, so that the competition which is there going to happen in the market, we should be able to manage it. So overall, these things comes under planning. And then, okay, which one to go ahead with? That's decision making. And once you've gone ahead with it, then how are you going to do it? What is the platform which you need to make? What is the path which you need to have to control these particular plans which you have to make sure that you achieve it? That's really important for you guys to understand, that you plan, you make decisions, and you control things so that it is in place with you. So these all things comes up in an organization if you want to start. Now the question is, when can you start an organization? That's something which you can answer yourself anytime. See, input, system, output, plan, budget, control again. It's a loop. So there are a few test your understandings which you guys can go ahead, do it. If you're having this particular material with you, then you can do it right away with you. Then coming up towards strategic plan, levels of planning actually, strategic planning, tactical planning, and operational planning. In strategic planning, you will be having a 5-year plan of the organization. You will be taking the whole organization into control. Just think about it. You would have got this question: how do you see yourself 5 years from now? How do you see yourself 10 years from now? That's a question many people around you will be asking most of the times. I've got that particular question many a times. I've always given a question so that he be happy, and it's fine for him to listen to my answer, and he'll be happy and fine, and he'll not impose me another question for it. So nobody knows what's going to happen tomorrow. Nobody knows what's going to happen after a week. How are you going to know? What do you see yourself 5 years down the line? So that is an aspiration. And sometimes that aspiration which you have, that, okay, I want to see these many number of sales. I want to see these many number of employees joining my organization. I want to see these many products launching in this particular organization. It is like, you aspire your organization to be seen at that particular place. And that's what you have: a 5-year plan, you have a 10-year plan, you have a 20-year plan. But once you have that plan, what happens is you break that plan down. And make it towards your tactical plan. Suppose you have that 5-year strategic plan, you break that down into one year plan and make it as a tactical plan. And once you have that tactical plan in place, you again break that tactical plan down and make it a operational plan. Like next month what, next day what, next week what we have to do, like till tomorrow what I have to achieve. Like right now I'm recording this on 30th of December. Maybe this will be live on 31st of December, or maybe after some days. I don't know when it will be live. So what's the plan for today? What's the plan for tomorrow? That's something which will be done in operational planning. Okay, moving forward, cost, revenue, profit, and investment centers. So these are responsibility centers, talking about one particular responsibility to be taken care of. Like number one responsibility center is the cost center. This is a center which takes care of the cost, which takes responsibility of how the cost is getting recorded and why you need to record cost. See, these are those centers which are responsible for doing the work, and they don't give us any revenue. They are just a cost to us. For example, if there is a call center, customer support service. A customer support service in an organization is required. Now, when that's required, that's a service given back to the customers. Are you going to earn something again from it? No, you're not going to earn it directly from it. Maybe indirectly you'll be earning, but not directly. So something which you have to pay them a salary, that is a cost to you. That's a cost center. Now, can it be like it is a cost center? Can we avoid that cost center? No, you cannot. That those people are really important for the organization to survive, because that acts as a support system. That acts as a cost center. That is a cost center actually. That acts as a support system. So that's something which an organization requires. Accounting will not give you, suppose in an organization, if there is an accounting department is not giving revenue for the organization. Me and you accountants are not giving revenue for the organization. What we are doing, we are supporting the organization. The salary which we are getting is a cost to the organization, and the organization is happy to give us that particular cost because they are going to get benefit in another manner. They are not going to get a direct benefit from us. So that's why we are support system. That's why we are called a cost center. Same goes another center, which is a revenue center, which will earn revenue for the organization directly. So sales department, kind of marketing department directly, I cannot say, but sales department is a thing which says that, okay, this is a place where we've got money from, and this is the revenue which we have got, and then this revenue gets shared among all departments of the organization. Okay, I hope that you guys are understanding. If you guys want to support us, put it down in the chat section. You can see in there what's that new feature there. Anything, if this is supporting you, if this is helpful for you, you guys can support us back for it. Okay, now then there is profit centers. Profit centers are those centers which take cost and revenue at a place, and then you take the benefit out of it and get forward from there. Your revenue minus your cost, that becomes your profit center. Okay, then comes investment center, in which you would sit back and look forward for how and where to invest the profit which you're having. Looking forward that how you can have your return on capital employed to be maximized. These are the things that you would be doing in investment centers. Okay, then moving forward, we have financial accounting, cost accounting, and management accounting. So I've made a detailed video, in fact, not detailed, a 5-minute separate video for financial accounting, cost accounting, and management accounting. I'll put the iCard above here. Here I'll put it above. So make sure that you guys watch that video also if you want to after this session, or else anyhow, I'm going to just explain it in a couple of minutes. So financial accounting, something which has already happened. You are just recording it. Management accounting, how things can happen. You want to know about it. You plan for it. That's management accounting. How do you cost a product? That's cost accounting for you. So historical financial accounting, something which is future oriented. Management accounting, something related towards the cost of the product. Cost accounting. Okay, then non-financial information, financial information. See, in management accounting, you would be taking non-financial information a lot into consideration before making decisions of the organization. You're going to take non-financial information a lot into consideration before making a decision. Why? Because these are those factors which may affect the organization on a longer term. Not just, just seeing, okay, what's the profit which you are going to get? How much are we going to earn from this particular deal? No, you should also look out for a longer perspective. You should look out for a very longer perspective and see that whether it is profitable for you in the longer run. Then only it should be taken up as a decision. Now, why I'm talking about a lot of decisions is that in management accounting, you will be taking a lot of decisions, and decisions are going to make or break organizations. See, till now, if you've completed your 12th, there was no decision to be taken by you, major decision to be taken. Like, you completed your 10th, you completed 11th, 12th, you chose commerce or you chose maths and commerce. Now it is up to you to make a decision that what you want to do next further. Though we say that you get influenced by decisions, but if you are watching this session right now, it is your decision which you have taken to do this. Nobody has forced you to do it. So your decision-making journey has started. What you have to do tomorrow is your decision to make. Now, I'm not telling you that, okay, you have the control of all decision making in hand right now, means I'm not saying that. You have decision making in your control. Be wise in that. Be wise in that. Be a make some decisions through which you should not be regretting it, and you should be happy with that. Okay, so there are non-financial information which you need to take into consideration while making decisions. Then there's difference between the two. Again, we've already talked about it. The role of management accounting within an organization, MIS, Management Information System, you can see in here. Annual statutory record, budgets, forecast. These is the main thing. You'll be earning a lot if you get into this particular department. Now, just getting into that department is not the goal. You should be financial, you should be skillful also in understanding how do you budget organization, how do we forecast things. That also you should be a bit strong there. Then product profitability reports, which you would be creating. Cash flow reports. See, these are reports they're talking about. Then capital investment appraisal reports, standard and variance cost reports, return to government departments, sales tax. And these are few of the things which management accounting people will be doing on a regular basis. So I guess we have we have some limitations also with the management accounting information or management information. Like management may fail to comply with the accuracy which they are providing. See, most of the times when you are going to budget something, so now when you're going to budget that was going to happen in this particular year, in this particular organization, there are times that you may overestimate some stuff. There are times where sometimes you may underestimate it, and that goes completely wrong. So what you need to do, reconsider it. And that's what they are saying, that you may fail to comply with accuracy. You may fail to comply with timeliness. You may not be able to create those reports on time. You would not be able to generate reports in such a way that everybody is able to understand it. That's a bit of a challenge. And then moreover, you have these understanding relevant cost and revenues. What are relevant cost? Future incremental extra cost cash flows which are going to happen in the future, or which are going to be relevant towards your decision which you are making for an organization. Those are relevant costs. Those costs which have already been incurred are not to be considered. We are going to do that in detail in the cost accounting chapter. We are next is cost accounting only. Non-financial information, a processing company needs to increase its output in order to take advantage of an increase in the total market of its product. Total market of its product, non-financial information, market share, all kind of stuff. So moving forward, external information. These are the things which organizations need to consider. Okay, whether it is internal information, external information, that how things are going to change up in the market. Like lockdown was happening. What was it? In financial information, that was a non-financial information at first. If at the start, if you would have got it, but later on, it became a financial concern for the organization at large. Why? Because lots of business processes were struck, and they were struck so hard that you needed to have a plan B, a plan C, a plan D for it, because nobody thought that this is something which is going to happen, but it happened, and we should have a plan to enact for it. Okay. Moving forward, these are something which you guys can read it off. Let's move forward towards the next chapter, which is chapter number 4, in which we'll be going more in detail of the cost accounting concepts. So here we are with this particular chapter, which is cost classification. We are going to do cost classification, then accounting for material, accounting for labor, and accounting for overheads in this particular session itself. So make sure that you watch it till the end. 5 chapters will be completed. 5 chapters of management accounting will be completed in this particular session. So, all right. So if you just see in here, we'll be going through analyzing the cost, like cost for a particular product, which is cost object or a cost unit. We are going to use these costs in preparation of financial reports and stuff. So what exactly is a cost object? Okay, like suppose this mic is a cost of cost object. Okay, let's just take it as a cost object. So what is the cost of this particular mic? To make this mic, what is the cost? Maybe this particular stand is coming for $2. The wire is maybe $2 again. Then this set of mic is maybe $10. Maybe the software which is there inside it, maybe that is $3, something like that. So these are the things which are material, which I'm talking about. So these are something which I have to go buy it from the market. Okay, that is the material cost. Now, what about those people who are going to assemble this, which is nothing but labor? Okay, the labor which is going to be levied on it to make that particular mic. Then comes overheads, like what is the rent of the place at which you are making it, what all are the overall cost incurred in making that particular place so that we can make this mic. These all are the cost levied. So what all are there? Overheads are nothing but my indirect expenditure. So my material, the cost which is taken, or the materials which are required to make this particular product, then the labor to convert that materials into a product, and also the overheads, overall overheads, so that I can what all the cost direct expenses are there directly attributable to the product, I can put it in there. And then comes your non-production cost, then comes your fixed cost and all that stuff. Those will be taken into consideration later. A cost unit, example of cost unit, like a room in a hotel, a liter of a paint, a patient. How do you cost it? Like, okay, how many liters of paint you want? So the cost unit here is the liter of paint. I need 5 liters of paint. So per liter, I'll multiply it with the cost amount and I'll get the cost of that particular product. Then comes cost center, that how are you going to put it? A department, a machine, a project, a ward. That's how the cost will be levied. Then comes your cost cards. You see here, I just talked about material, labor, expenses. This will equal your prime cost. These all three put together will be equaling my prime cost. Then will be variable production overheads, fixed production overheads, and then the non-production overhead. These all are the production overheads which would be taken into consideration. Now we are going to explain those terms in further detail. Now this is a cost card of a particular product. As I just said, you to make this, what is the material required? Maybe wood, paint, not wood actually. This is something else through which we are making it. Then who are the labors which will be assigned for it? Like how many units of this particular thing is required in small bits and pieces. Or else, if suppose this is a glass, what's required for a glass? Plastic. Yeah, this is a plastic glass. Plastic will be required and a molding machine will be required so that we make this particular glass. Okay, so that's what you will be requiring. That's material. And then you will require labor, those people who would make that glass or make that particular object. And then the overheads which are required directly attributable to that product. Some cost, some transportation, some these type of cost will be taken into consideration, and then you come up with your prime cost. Then you have your other variable production overhead. Now what is that other variable production overhead? Sometimes, not sometimes, most of the times, all the time, you have another labors which are those labors which would be that white collar labor, you call it, like people like us, like administration, accountant, management accountant. These people are also labor. We are also labors, but we are paid salary rather than wages. So we would be considered under indirect cost, not cost which are directly attributable to the product. That won't be there. We are the people who would be paid this fixed production overheads kind of a stuff, salary. Okay, then you come towards your total production and your administration, selling, distribution cost. Now we'll be classifying these costs in different manners, like element, nature, function, and behavior. So let's get started. So cost by element, it is material, labor, and overhead, which is we have already discussed about. Now classifying it by nature, which is direct and indirect. Now what is direct and indirect cost? Now costs which are directly attributable to the product. Now you see here, this mic, I have used this particular product. This thing is a product. Okay, direct material. Okay, this is direct material which I'm using it. Suppose I'm using a screwdriver just to tighten this up. Okay, just to tighten this up, I'm using a screwdriver. That screwdriver is also a material, but am I attaching that into this product? No, I'm just using it and then I'm keeping it back. Okay, on this mic, I'm using a screwdriver to fix it. That's also a material for me, but I'm using it to fix it and then I'm keeping it back. So the whole product from top to bottom is going to be my direct material. And this particular material, which I used it just to fix that, that is my indirect material. I hope that my voice is coming properly because I'm, moving around with that mic, but still my voice is coming properly. Okay. In that same manner, labor which is fixing that particular mic is a direct labor, but a labor who is used in transportation of that is an indirect labor. I hope I'm making clarity to you. Then you see here, direct expenses or overheads are the royalties paid to a designer. In that case, you can see cost of renting the factory where the shirts are manufactured or these mics are manufactured. Are you understanding the difference between cost and direct cost and indirect cost? Directly attributable to the product, direct cost. Not directly attributable to the product, not getting attached to the product, those are indirect costs. So what all we've done till now, we've talked about classification by element, we've talked about classification by nature. Then coming up towards next classification, these are test your understandings. I'm not doing it because a revision session it is, but still some questions we'll be doing which is kind of more difficult for you. I'll be doing that. Then classification by function. Okay, production cost, number one, production cost, and then you can see here non-production cost. Now production cost, non-production cost, how are you going to differentiate with it? Now production cost is the cost levied from start till end to make the product. To make the product, the cost levied. Then comes to sell the product, how much time is it taking and what all are the costs taken. See here, cost to make is direct material, direct labor, direct expenses, variable production cost, fixed production cost. Done. Production cost. Then comes, how do I sell it? Where do I sell it? How do I manage these sales? Administration cost, selling cost, distribution cost, and finance cost. These all are the costs levied to sell these particular products. I hope you guys are getting clarity. If yes, then put it down in the chat section or the comment section, whatever is there. If you're watching this live, put it down in the chat section. If not, then put it in the comment section below. Also, if you're having doubts, chat section, put it down. I'm looking into that chat section right now. I am looking into that chat section right now. Okay. Then we have to classify these particular cost in these classifications. Which type of cost is this? You guys can pause this session and answer this also. Okay. Classification by behavior. Very, very, very important. Your variable cost, your fixed cost, your semi-variable cost, your and your stepped fixed cost. Semi-variable cost or semi-fixed cost is almost the same only. Half semi, half variable. Sorry, half fixed, half variable, half fixed is one and the same only. Now the question is, if the question arises is, what is the stepped fixed cost? Let me explain this to you with an example. These are glasses. Okay, I have to buy this glasses. Okay, these are not numbered glasses. These are just like, blue screen glasses. I take it while I'm using a lot of my computer or my laptop sometimes, so that I don't get any problem with it. So I'm not wearing this glasses just because maybe you may not be able to see my face properly. That's the reason I'm not wearing these glasses right now. Well, if I have to buy these glasses, these one pair of glasses is equals to $10. Okay. I have to get this particular glasses. That is a variable cost to me. Okay. Variable cost to me. If I have to get 10 number of glasses. So 10 into 10 is equals to 100. 100 is my cost of getting these 10 glasses. If suppose I have to get 5 glasses, it is $50. Why? Because 5 into 10, 50. If I have to get 100 glasses, then my cost of 100 glasses will be 100 into 10, and it will increase as the number of glasses are increasing. So here, my variable cost per unit is the same only. It is $10 only. All the time it is $10 only. If the number of glasses are increasing, then it is increasing. My total cost, not my per unit cost. My per unit cost remains the same. My total cost of these glasses changes, and it increases as the number of units increase. Same goes with this variable cost. Variable cost per unit remains the same. Total variable cost changes as the production changes. Simple. Now, let's take an example for fixed cost. Okay. For fixed cost, let me just take an example like I am ordering a particular product. Okay. A particular product from one place to another. And for that, I require a huge truck, a truck loaded with those. Let's take, I've left that glasses. Let's talk about this glasses. Okay. I have to drink water with these glasses. I'm ordering these glasses in bulk. Okay. I'm ordering it in bulk. Maybe you can talk about that. I want to order it in size of 1 ton. Okay. 1 ton. I need it. And I'm ordering it from a huge truck from point A to point B. Maybe take it from Mumbai to Hyderabad. I want it. Now, if I have to order these number of glasses, I'm ordering it from a truck. That truck driver, truck or agency or whatever, they are telling me that the cost of that order will be equivalent to 50,000 Indian rupees. I said that, okay, fine. So they said their rent is 50,000 rupees from Mumbai to Hyderabad. Now that's an example, hypothetical situation. I don't know the actual cost of it. 50,000 to get 1 ton of these glasses from Mumbai to Hyderabad. Now, if suppose I am ordering 70% of that particular order, like 0.7 ton I am ordering. So the number of units which I have ordered has come down. But how much will that person charge me? He will charge me 50,000 only. He'll say that how much amount you want, that is irrelevant. I am bringing that particular vehicle from that place to this place. I'm going to cost my 50,000 only. So that 50,000 is a fixed cost. Okay. That 50,000 is a fixed cost. It does not matter how much amount of units I'm bring it. Now, suppose if I want to order 2 tons, 2 tons, if I have to order, what will he say that in my one truck, I can bring 1 ton only. For another ton, you have to get another truck. So what has happened? This fixed cost, 50,000 was there. I've got one more fixed cost above it. So this becomes my stepped fixed cost. This becomes what? Stepped fixed cost. That was what? One truck coming in, fixed cost. Now understand the logic behind it. Now the calculations behind it. I hope that you guys are able to follow with me, be following with me. Okay. This is not a regular class. Otherwise, sab likh ke bata deta aapko. Follow up here. Fixed cost, if the number of units is decreasing, the per unit fixed cost will increase. And if the total quantity is increasing, the per unit cost will decrease, per unit fixed cost. Wo kaise? Understand this. Suppose I am getting 1 ton. Where's my pen? 1 ton is equals to 100 kilos, 100 kilos. Sorry, 1,000 kilos. Okay, 1,000 kilos, whatever it is, yeah, just take it, 1,000 kilos. And I'm ordering it for 50,000. Okay, so per kilo, per unit, how much is my amount? So it is 50,000 divided by 1,000, which equals to 5. 5 only, right? No, 50. 50 it is. Now, if suppose this, I'm ordering it to 70%. So again, 50,000 is levied, but it is divided by 700. So what has happened? The per unit cost has increased. The per unit cost has increased. Suppose the amount of goods which I want has increased to 2 or maybe 1.2 tons, or suppose 50,000 divided by 1,200. So what has happened? The amount has gone down by 50. The per unit cost has gone down, but the total fixed cost remained the same. Total fixed cost remained the same. And in another scenario, what has happened, where I required two or more trucks is required. What has happened here? I've got a stepped up fixed cost. I hope you guys are getting clarity. Then comes semi-variable cost. Semi-variable cost, best example is the electricity bill which you get. Some portion is fixed and most of the portion is based on how much you use it. Some is fixed, some is based on how much you use it. Now, for semi-variable cost, how much is fixed, how much is variable, we need to calculate it. And to calculate that, we use high and low method, which we are going to do it right now. I'm going to explain that to you. I'm going to explain the tips also, that how you should be using high and low method. For now, variable cost done, fixed cost done, step fixed cost done, semi-variable cost, we'll be doing it on the high and low method. We'll be doing over it. So there are high chances that you may get these type of graphs in the examination and asked which one is semi-variable, which one is fixed, which one is the stepped up fixed cost. You'll be getting it from the graph. So if you just see here, the first graph shows what? This is variable cost in total. Total variable cost increases as the production increases. This is variable cost per unit remains the same. Glasses example, $10 remains the same, इसलिए flat line है. $10 depending on number of units increasing, it goes forward. Okay, then another example. Now what is this? Okay, they have taken numerical examples, but we can move forward. Semi-variable type of a cost. What are they doing? Fixed cost remains the same. Total fixed cost remains the same. Per unit fixed cost goes down. Per unit fixed cost goes down. Then what is there? Some examples they are giving. You guys can go ahead and try solving those examples. For now, I'll moving forward. Stepped fixed cost. Stepped fixed cost you can see in here. This is how the cost of that particular, the more trucks you require or the more outlets you require, your fixed cost will increase. Okay, now semi-variable, you can see in here that, see, this much portion is fixed and others is increasing, or else you can see in here it is going down but not going below this. So that is a semi-variable cost. Moving forward, let's go towards high and low method. See, short example also you have, through which you can answer that which one is variable, which one is semi-variables, which one is fixed, which one is fixed cost per unit. You can answer this here. You guys will be able to do it. Now, identifying cost behaviors. Behavioral costs, that fixed costs are constant in total, variable costs are constant per unit, semi-variable. Okay, so you're just identifying that. Again, a short illustration is there. Fine, let's move towards high and low method. Really important for you, important for 2 marks also, and also important that it may come as a part of a bigger question which you're going to have. Okay, so It is really, really simple if you do it in the right manner. In fact, the simplest thing. Okay. I'll make sure that I complete that glass, and then again I have another glass till I complete all these chapters. Okay. So variable cost per unit you have to find out at first. Now, how are you going to do that? Let me just do it with this particular question. Okay. This is where I'll be applying this high and low method. Okay. I'm doing this for you guys now. This is where I'll be applying high and low method. So for the first thing, what will I take? I'll be taking the highest cost at the highest unit. So what it is, 9,000 is the highest cost at 400 units. So I'll take this 9,000 and I'll minus it by the lowest cost with the lowest unit. So lowest cost, lowest unit is 7,000. 7,000 divided by, I have to take these outputs also. So what it is, 400 minus 200. I have taken the highest, I have taken the lowest. Highest and lowest I have taken. Now I have to take the difference between the two and I have to divide these two. If I take the difference between the two and I divide these two, what will I get is I will get my variable cost per unit. Now, how much is that? See, 9,000 minus 7,000, 2,000. 2,000 divided by 400 minus 200, 200. So my variable cost per unit is 10. My variable cost per unit is 10. The number of units which I am selling may be 200, maybe 300, or maybe 400. Now, let us just take into consideration my variable cost is 10. How much is my fixed cost? I need to find out. So this 7,000 is my total cost. Yes or no? 7,000 is my total cost. I'll take this 200 first. I'll take this 200. I'll multiply it with 10, which equals to 2,000. So out of this 7,000, 2,000 is my variable cost. So the balance is my fixed cost. Balance is my fixed cost. So I've got my fixed cost. I've got my variable cost. Clear? So what is the question here? Variable cost, 2,000. Fixed cost, 5,000. Now the question is the total output if the cost is 350. Okay, so 350 is the cost. What should be is nothing but 350 multiplied by variable cost per unit, which is 10. That equals to 3,500 plus 5,000 is my fixed cost, which equals 8,500. Fine. Then again 600 they are asking. 600 into 10 is 6,000 plus 5,000, which equals 11,000. Clear? That's what they did. This is a simple question of high and low method. Now coming towards some places where high and low method you have to apply it is a bit challenge. Now in this particular question itself, it is a challenge, I'll tell you. See, most of the times if I say you have to take high and low method, what will you do? In this particular question, which is the highest amount? Which is the highest amount? Highest amount? This is the highest amount in total cost. But is it the highest number in units? No, 50 is the highest here. What should you do? What should you do? Here is the challenge. See, you must not look in here for the highest and lowest. You should look in the output number of units. You need to see which is highest, which one is lowest. So here 26 is the lowest. Here 50 is the lowest. Okay, you've taken it. So what is the cost related over here? You need to take this and you need to take this. Okay, you should not take this 7380. This is the highest. No, the highest cost with this highest number of units, and that should be taken. So that's how you should take and then calculate it. Then you should do this 7310 minus 6566 divided by 15 minus 26. You will get the variable cost per unit. Once you get that variable cost per unit, you multiply it with any number of any of these units. You multiply it, you'll get your variable cost total, and from that variable cost total minus this total cost, you will get your fixed cost, and so on and so forth. You will be doing it in the same manner which I have just done it in the previous question. So here comes another method in which there is a step to fixed cost. Step to fixed cost is there. What is the total cost of the activity of 5,000 units? Let me just do this for you again. See what happens here. is variable cost per unit is constant within the activity range. There is a step up of 10% in fixed cost when the activity level exceeds 5,500. So what you need to do, you should do a high and low method application at a particular amount in which there is no difference of changes. Like, see, if I'm taking this 40,800 and this 54,800, in this, what has happened is there is a 10% step up fixed cost which has already taken into consideration. So if I take these two amounts, this highest and this lowest, I will not get a proper answer. But if suppose I'm taking these amounts which are after getting affected, okay, if I take 6,000 and 7,500, is there a change happening in between the two? There is no change happening in between the two. So what will I do is nothing but I'll take these two amounts in highest and lowest, these two amounts in highest and lowest. So it will be 4,800 divided by 1,500. So I don't have a calculator here in front of me. I should be opening it in here. So calculator is here. What should I do? I need a standard calculator. 4,800 divided by 1,500, which is equal to 3.2. 3.2 is my variable cost per unit. Now I've got my variable cost per unit. What is he asking? I need to again find out my fixed cost also. So 3.2 is my variable cost per unit. Let's take the 6,000. 6,000 into 3.2. Where's my calculator? Okay. 6,000 into 3.2. 19,200. So 19,200 is my total variable cost. So what is my fixed cost? What is my total cost? 50,000. So 50,000 minus 19,200. How much is my fixed cost? So I'm getting my fixed cost here, which is nothing but 30,800 is my fixed cost. Now this fixed cost which I am having, it has already been affected with a 10% increase. So what should I do here right now? I should remove that 10%. So 10% is already included in it. So when that 10% is already included in it, what will I do? I'll do 30,800 into 10 divided by 110. So where's my calculator? 30,800 multiplied by 10 divided by 110. 2,800 I have to remove, which is a 10% effect. So I am minusing 2,800. 2,800 I am minusing. How much will be my fixed cost? 28,000. So 28,000 my fixed cost for this 5,000 units. Now I need to get my variable cost per unit. Variable cost is 3.2. 3.2 into 5,000 is equal to how much? Again, calculator. 3.2 multiplied by 5,000. 16,000. Now 16,000 plus 44. Sorry, it is 44,000 actually. 16,000 plus 28,000 is equals to 44,000. इतने बार कर रहा हूं मैं ये क्लास में ये problem. I just remembered the answer also. I hope that you guys are getting this. In that same manner, you will be having the variable cost which is changing. So what you have to do with that change is again apply those, take those two units. Like suppose estimating cost of unit 450, they are asking. For output volumes 350 units, the variable cost per unit falls by 10%. So falls by 10% after 350. So what you should take 200 and 300, take it into consideration and apply high and low method. After that, do a effect on the variable cost per unit. Then that will be fine. Okay. So then comes this cost equations. Cost equations is just a basic understanding that how you find out the cost, where in y is equals to a plus bx is going to come in your CMA management accounting for a longer period of time, in which just see in here, A is the fixed cost per unit, B is the variable cost per unit, X is the activity level, and Y is the total cost. So it's just to find out that high and low method. It is a variable, sorry, a equation method also. You don't need to get in detail with that. the how much, high and low method, that will be more than enough. Now moving forward is cost codes. Now cost codes is something which is just like suppose I'm having this particular mic, I'm having this particular headset. If I'm having 10 headsets, so what should I do? Okay, I'll code this like Turtle Beach. I'll code this headset TB. I'll code this one like 01. I'll give them a numbering and I'll have all my cost in here. I have another mic for my, what do you call, for my camera. So I'm giving them names, I'm giving them codes. Me giving them codes is something which is relevant towards just normal coding or giving numbering to those particular products or particular materials. Okay, nothing as such. Like say sales, S is the code for sales representative expenses, ED is the code for Eastern Division, P is the code of petrol. Then you have sequential code like 0000 is for expenses, 1000 is for revenue, 2000 is for non-current assets. So in that series it goes on. That's just a block code kind of a thing. Hierarchical code, revenue from UK 0.1, revenue from UK 0.2, digit codes. Nothing as such in detail to go with. That's what is with this particular cost classification. There are some testing understandings which you guys can go ahead do it. We have completed this chapter revision also. Now we'll be going towards accounting for material. Let's get forward now. If you once again, if you want to take breaks in between, take a break in between and then come back. You can pause this and then come back again here. Okay, so now I'm also going to take a break right now and then moving forward towards the accounting for material. So let me just get started with accounting for material. Okay, so now with the accounting for materials, one of the most important chapters, one of the main chapters, which is accounting for materials, accounting for labor, and also accounting for the overheads. These are the main things which make a prime cost of a product. Okay, so the main direct costs which are attributable to the product. So in here, if you see in with the materials, we have the ordering, receiving, issuing inventory. These are all things which we need to take into consideration. In fact, we will be finding out that in what optimum order size we need to order the materials, when we should be ordering the materials, in what way we should value the inventory of the organized inventory of the materials, not the final product. How are we going to do that? We are going to do it in this particular chapter. Also, we'll be talking about the safety levels, safety stocks, which are to be kept so that you are not out of the sales or not out of the requirement which is required for it. All right, so let's get started with this particular chapter. Now if you see in here, it enables 1 second, ordering, receiving, and issuing. Let's just get started towards it. Now you just see in here, first of all, there will always be a requirement which is raised in the by the workers out there in the market, in the industry, at the job place. There will be people who would be working out there, and once they are working out there, they will be coming up by that, okay, this is the material which is pending, this is the material which we don't have, or according to the budget you should be having this particular amount of materials. So what happens is there is a requisition note issued to get the materials. There should be a requisition note to issue the materials or to purchase the material. Now who will do that? You just see in here, the stores department. The stores department will give it to us, the production department. Okay, now the production department, what would be the do? Sorry, not the production department, the production department is nothing but laborers will give them that this is the product which we actually want towards the store department. Now the store department will order it or give it towards the purchase department. The purchase department will look out for different vendors which are there in the market. From those vendors, they'll try getting that stock. Now let me just keep that into a particular example. Suppose there is me who is telling that I need books. I need huge quantity in books so that I can give it away to my students. So who's telling this? This is me who is telling it. That is a production department. Okay, the production department. I'm going to issue this books to you. So I'm the main user for it. So what do I say is nothing but towards the stores department, whoever is sitting in the stores department, whoever is liable to do this particular work, that I need this 100 sets of book. Okay, 100 books I need. So what will that store department do is go forward towards the purchasing department. The purchasing department will look forward for different vendors. They'll ask for quotations that, okay, how much are you going to give this 100 pieces of books for? How much are you going to give this 100 pieces of book for? How much are you going to give? So what will he do? He'll have 3 to 4 quotations in front of him. Once these quotations are there, he'll look forward, he'll cross check and see which one is best for the organization, and he'll order from that particular vendor that I need these 100 books. Now these 100 books, where will these 100 books directly go? Is nothing but it will go towards the stores department. If you just see in here, the purchase department gave the order towards the vendor, the external supplier. The external supplier supplied it towards the stores department. The stores department went and give it towards me, so that now I can give it forward towards my students who are there, or whoever is there whom I want to give it, I can give it. So there is a process which has happened. There was a need, there was a requirement. Now that requirement was raised towards the upper level management. The management then gave it the order towards the purchase department that we need this stuff, you guys need to get it for us. And then they gave a requisition for quotations, and once they got the quotations, the best quotation, they ordered from there. And once they've ordered from it, they gave it towards the stores department, and department forwarded to us. So that's a normal process which happens. So I have been dealing with this particular process for I was in mainstream, doing this work for at least 2 years. I did this work regularly, getting the purchase order, trying to get the purchase order. Because if an organization is getting purchase order, see, suppose if I get a purchase order, that is business for me. If I get a purchase order, that's business for me. And that is something which is, yeah, we've got the contract, or we've got that particular deal. Now we have to go ahead, work for it. And according to the deal, then payments will happen. That's another case. But to crack that particular contract, now to crack that particular contract, or to crack that particular deal, what we need to do is nothing but we need to send in our best quotation. Okay. Now, if you see in here, this purchase department, okay, this purchase department is having power. He is having power to get whoever vendor he wants to, and he would get the best one. So there are many external suppliers waiting there to get work. I was one of those external suppliers while I was working in Dubai. So we were waiting for work to come. So if there is a need of quotation, then we made sure that we get we give the least and the best quotation. Okay, we give them the best quotation, that these all are the stuff which we are going to do in our service, and this is the product which we are having. So if we put in towards them, then they will be okay. Yeah, chalo, these people are good enough. Let's go ahead and give them business. Now, here comes the costing part. At what cost should I cost my service, my product, which I'm going to give them? It should be best in the market. Now, you will not have the exact knowledge or the exact information what the other people are quoting to that organization. You should be competitive enough. You should know at least that, okay, what they can do. In fact, you will not even know who are the other competitors. Most of the time, they keep it so confidential. We give that quotation, we try getting it. Once we get it, then that's the time that, yes, we've got the purchase order. Now is the time to give our services. You give the services, you get the payments. Now, payment getting also is another task which is to be done, because once the delivery is done, you would be getting the delivery note. That delivery note, you would have one copy. The stores department will have a copy. The stores department will forward it to the purchase department, and we will make a invoice in we'll make an invoice, and we'll also have our own delivery note copies and forward it towards the purchase department. The purchase department will cross check both of them and then forward it towards the finance department, or else we need to forward the invoice to the finance department, and purchase department will send a copy of the delivery notes from their side, that this is something which we have received, you must issue them the payment. Now, the finance department will look into that, how much are the days mentioned in the local purchase order. Now they look into, okay, these are the dates at which we need to make the payment, 30 days credit, 60 days credit, whatever it is. According to that, they will issue the payments. That's how that process goes on. And I hope that you guys are getting what the explanation I want to give in. There are many things which we take into consideration at that time. Now, there are some specimen forms of purchase requisition and stuff. It's not required for you to remember these formats and stuff, because they'll not be asking you to draw these formats. The only thing is you need to understand how the process is going on, so that you have a proper understanding about it. Like suppose if I go to a shop, I purchase this book, I come back, I get a bill, that's it, that's done. But that happens when you're doing and dealing in cash. But most of the time, those dealings will be happening in on credit. So you need to look into that, who the supplier will be. You need to get in that supplier and then get that stuff done. Like suppose a few days back, we were in a store, and in that store, there is like T-Mobile is an organization. They had really good, back covers and cases for their iPads and their mobile phones, and that was for their employees only. It was not for sale. So how did they get that? Is nothing but they have a regular supplier who supplies them. That's not available in the market. That's not available to the customers, but that's available for them. So how do they do that? It's the same process. They have a specific requirement for it and they get that approved. Okay. So now moving forward towards inventory or holding and ordering costs. So these are the costs which are associated in here. What are the costs? The purchase price, the holding cost, the ordering cost, the stock out cost, and inventory recording system cost. Now that's fine, but just see this: purchase price, holding cost, ordering cost. For now, let us just keep our concentration in here. Cost, stock out cost also will come towards it. Purchase price is the purchase price at which you have to purchase it. Once you purchase it, comes various cost with it. The holding cost. Holding cost is nothing but which you need to keep it in your warehouse, or you need to store it somewhere. Like first of all, the opportunity cost of which you are putting your amount there. Like suppose I've purchased this headset. Okay, I purchased this headset for maybe $50. Now I've invested $50 in here. If I had not invested this $50 here, I could have invested it somewhere else, and I could have got some more profit out of it. So what is the profit? What is the revenue which I'm going to get from it? That has been foregone. That is the opportunity which has been lost, the capital which has been tied up in this particular headset. So that's an opportunity lost for me. Then I have insurance, deterioration, obsolescence, damage, pilferage is nothing but another kind of a damage. Warehouse upkeep is nothing but regularly maintaining that. Stores, labor, and administration cost. These are the costs which are levied on me. These are the holding cost. About that is ordering cost. Now what's there in ordering cost is the amount which is levied to get the product in here till here. Okay, to get the product here, I would be having ordering cost, which is nothing but maybe to pay for the truck, or maybe to pay for the transportation. That all stuff is that ordering cost. And then comes in stock out cost. Stock out cost is that cost which will be levied or which will be incurred if you do not have stock in hand. Suppose I am selling these books. There's a customer who's walking in my place and asking me that, can you give me 100 pieces of this particular book? If suppose I have 100 pieces of book, well and good. If I don't have 100 pieces of book, I'll tell him, can you come tomorrow? He'll say that, okay, fine. He'll leave that store. After that, what he'll do? He'll go to another store and buy these 100 books, and that will be done. I have lost a sale of 100 books. And why did I lose a sale? Because I did not have that stock in hand. Because I did not have that stock in hand, that's the reason I lost that sale, and that's my stock out cost. Okay, now inventory recording system is done maintaining a stores ledger card or maintaining an inventory system. In fact, having an inventory system is one of the best things which organizations can have, because it will help you to understand that where you're standing in the organization, how much raw materials you're having, where is that raw material stored. That's really important for you to have a proper system which is a recording, and how much is the age, for how long is that particular raw material lying in the godown or the warehouse, which is eating up space just like this, which is not performing at all. You'll understand it if you have a system for it. If you don't have a system, then everything will be manual, your decision to be taken, that whether should I order this again or not. You'll understand this right now, because we are going to do this optimum reorder quantity. So just holding cost, how do we calculate holding cost per unit of inventory multiplied by the average inventory? Average inventory, how do we find out, is nothing but the opening inventory plus closing inventory divided by 2. Now, cost of ordering is nothing but cost of placing an order and the number of orders which you are going to place. And that's your total cost, total annual cost of inventory. As simple as that. Now, disadvantages and advantages of high and low level of inventory. If you have high level of inventory, then you can meet up towards your demand. But if you have low levels of inventory, you cannot meet up your demand. If you have high levels of inventory, there is storage cost levied on it, and there are chances that it may get damaged. If you have a low inventory, you can lose out on those sales. So there are many advantages and disadvantages which you guys can go through. Let's move forward towards one of the most important topics. Now, this is a total of cost, all holding cost, ordering cost, purchase price. You total these three, you'll get the total cost of that particular product or that particular thing. Now comes reorder levels. Now, what is the time when you need to reorder? Let me explain that to you. What is the time? See, reorder level and reorder quantity, these are two things. Reorder levels is nothing but when you need to reorder. What it is? When you need to reorder. Reorder quantity is how much you need to reorder. How much you need to reorder. So reorder level, reorder quantity. Reorder level is when you need to order, reorder, and how much you need to reorder is reorder quantity. I hope you guys get that, and I hope that that is sinking in with you. Write that down. Okay, now let's move forward. Now, when you need to reorder, you need to set it up with a maximum lead time. Now, what is this lead time? Understand this. Okay, I'm having this particular Pringles in hand. Let's take Pringles as an example in here. Suppose I am a seller. Okay, I am a seller and I'm having 100 units of this Pringles. And normally in a day, I am selling 10 units. Normally in a day, I am selling 10 units. I'm having 100 in stock. So how many days it will get over? In 10 days, it will get over. Fine. Suppose it is getting over. How many days will it take for the supplier to supply me this top up of these Pringles again to my stock? Okay. How much time is it going to take? If it is going to take 2 days, I can order it on the 8th day, because for 2 days I'm having the stock left with me. I can manage my 2 days with 20 stock left over, and I'll order it by that time, and in 2 days it will get it. Suppose he is going to take 5 days to reach to me. That's nothing but lead time is nothing but 5 days. So how much should I do is nothing but I should take how much I'm using in a particular day, or my maximum usage, I should multiply it with my maximum lead time. So if it is taking 4 days, I should have how much? 40 units in hand when I have to reorder. Now, when is that 40 units going to come in, and how do I calculate it? In this example, it's straight. I have 100 in hand, and in 10 days, every day I sell on 10. Every day I sell 10, right? So let's take that minimum usage per day, maximum usage per day, and multiply it with the lead time. That's 4 days. 10 multiplied by 4, I get 40 units. In 40 units, when it reaches 40 units, I need to reorder. I need to set a system as such that I need to reorder at that particular point as the units come towards it. Okay, as you can see in here, 1500 per week. Time between placing the order and receiving the components is 5 weeks. Reorder quantity is 12,000. Now 12,000 reorder quantity, that does not make a difference in here. But how much it is? 1500 per week. Lead time is 5 weeks. 1500 into 5, that's it, 7,500 units. When I reach, I need to reorder. As simple as that. Okay. Same goes with this particular question also. Let's move forward towards economic order quantity. How much I need to reorder. Above one was when I need to reorder. This one is how much I need to reorder. Okay. You can just You can go through the graph if you want to, but I'll explain it in a more proper format. This particular formula, I've been doing it for economic batch quantity, cash management system, and also this EOQ. So almost it's covered in all, but it has been started with EOQ only, that how much is the optimum quantity at which I need to reorder. Now, why do I want to find out what is the optimum quantity? You need to find out the optimum quantity to reorder so that you do not incur heavy holding cost. You do not order much and just keep it in your storage, and you do not order less and lose out on stock out cost, lose out on the sales. Don't do that in two extreme scenarios. One extreme scenario is you are having huge stock in stock only and it's not getting sold. Another scenario, you are having very less stock or no stock and you're getting stock out loss cost all the time. These two are two extremes. Now when these two extremes are there, what you need to do is nothing but you need to get something in balance. Okay, now when you need to get something in balance, that's something which you need to consider a lot. Okay, 1 second, I guess I am having some work in here, just give me a moment. So when you have the purpose of understanding that why we require this optimum quantity to be ordered, then we can put it down to this formula, which is 2COD by CH. Now, you would be seeing this formula in different terminologies at different places, but what is the actual essence behind it? You can see the demand per annum, the cost of placing one order, and the cost of holding one unit for 1 year. That's what it is. Okay. This is what are the things which you need to just substitute in this particular formula and get your optimum quantity, which is desired to be ordered every time whenever you order. So in this case, what happens? Your least cost of ordering will be happening at this particular point, and also your optimum quantity which you want, so that you do not have that stock out losses and you do not have that heavy investment in your holding cost. These both will not happen. Now, there are, as I just said it earlier, okay, this will be the least total cost at which you need to order. That matters a lot, which we need to go ahead and see. I'm getting some messages that's disturbing me in between of the class. Let's get started, continuing with EOQ assumptions. The demand and lead time are constant and known. Purchase price is constant. No buffer inventory is held. So it goes on. So EOQ, you can see in here, if we have all these items present, then applying this formula is no big deal at all. And 100% you'll get that in your examination. EOQ, you are going to get it in the examination. So make sure that you're prepared for it. And total average cost is something you can just total up your holding cost, your ordering cost, and the purchase price, you get it. Average cost, so you just divided by opening plus closing divided by 2. Then EOQ with the discount. So these are different opportunities which you get. Suppose if your ordering size is 1000, so what is the total ordering cost, total cost of the order which you are going to make, and what is the total cost for that complete year? You need to calculate and then compare it with, suppose they say that if you order in bulk, then we'll give you some discount. Calculate that also and see the total, see which one is more profitable for you. In short, you are going to order some material. Okay, now to order some material in this manner, if you go, this is your cost. In the other manner which you go, that will be your cost. Now which is least is best for you. Okay, as simple as that. That's what they've written it there also. Like if suppose your order quantity is 1000, what would be your cost? If suppose your order quantity is 2000, what will be your cost? Compare the two, whichever is least, go ahead with it. Like suppose in this problem, 7128 is the least. That's why you go ahead with that. Okay, so we have been done with this economic order quantity, economic reorder level and stuff. Now coming up towards another point, which is EBQ is almost the same. Instead of having the quantity you in number of units, you have it in batch size, and everything is the same. You just have an annual replenishment rate is nothing but at what rate the goods will get perished or replenished. That's what is that particular rate. Nothing to bother a lot there. I'm going forward towards maximum minimum inventory. Now the maximum minimum inventories and also the warning levels which are to be kept are really important to be there. Suppose you have a bin. Now here there should be a bin with an example. No, it's not there. So see, suppose this is your bin. This is your bin in which you are storing your inventory. You should have your maximum levels, your minimum levels, and your danger levels at which your stock is there. So let's move forward now. Stock taking is nothing but counting of your stock. You periodically count your stock, or you continuously count your stock. It depends on organization and the nature of business you are in. Okay, examples and other issues, controls. Let's move forward towards valuing inventory, where the first example is perpetual. Perpetual is nothing but you do it on a regular basis. A regular basis, you are valuing your inventory. Regular, daily basis, as and when it happens, you are valuing. Then the other format is, see, perpetual, you see in here, you can go it with FIFO, which is first in, first out. You can go with last in, first out, or average cost at which you can order. You can record value your inventory. Now, let me just talk about these particular inventory levels or inventory methods. First of all, understand this. You do not have to make these tables. Okay. You do not have to make these tables. These tables, you do not have to make it. If you have proper understanding of the concept of first in, first out, and you have proper understanding of the cost of last in, first out, and the average cost, then this will not be a problem to you. See, per unit prices around 2 decimal, total figures are the nearest. This is the transactions which they are having. There's no question here. The question, did they say somewhere? Okay, this is an illustration. So this is the first week transaction which has happened. So most probably they'll be taking FIFO first, then they'll take LIFO, then they'll take average cost. So most of the times the question comes in is that what is the inventory valued at? Now, suppose if I'm doing this on FIFO method. So let me just see, my opening balance is 10. My receipts are 70, which is nothing but my additions. So my total stock here is 80. Then my issues are 40, so my total stock becomes 40. 80 minus 40, 40 it becomes. Then receipts more, 50 is there, so my stock becomes 90. And then again issues are there, so I am left over with my stock of 20. Now if I am following up first in, first out, my closing stock right now is 20. Okay, after all the purchases and sales, my stock is left over is 20. Now when my stock is left over at 20, at what rate should I value it? Okay, if suppose I'm doing my first in, first out, like, okay, I have this opening balance first, which has come in, that is going out. So whatever is the remaining, it would be those costs which is at the last which I have purchased. So it is out of this. Okay, now when it is out of this, what can I do is nothing but 20 multiplied by 2.3 and I get my answer. That's the closing stock according to FIFO method. Is that it? Is that what the answer is? 20 multiplied by 2.3, 46. That's what is the answer. Okay, now that's the simplest method which I just did it in front of you. They've just made a table for your understanding, for the explanation. If you want to go through it, you can go through it. Otherwise, just do it like this. It will be more than enough. Now, suppose you have to do last in, first out. Okay, if I have to do last in, first out, and 20 is my closing stock, what I'll do is nothing but I'll take these things in picture. Okay, first I'll take this 10, which is 10 multiplied by 2, and from here I'll take another 10, which is 2.2. So 10 multiplied by 2 is 20, and 10 multiplied by 2.2 is 22, and my closing stock will be 42 according to last in, first out. So let us just see in last in, first out, what did they do? Yes, it is 42. So it's nothing but how much is the stock left over, and from the start it is left over. That's FIFO, LIFO done for you. Then comes this average average cost of the product. So the total cost before issue and the total cost before So the total cost before issue, total number of units before the issue. Now this one matters a lot, which we need to take into consideration. Now here what happens is you take out the average at every sale which is going to happen. Before every sale which is going to happen, you take out the average, and at that average you sell it off. At the average you take that cost of that particular product. Like suppose this is the opening balance. This is again the purchases which have happened, 70 purchases which has happened. So what you do is nothing but you have this 80, you have this cost 154 and 20, so it becomes 174. So 174 divided by 80, you get 2.18. Okay, I hope that's clear. And at 2.18 you sell off that particular inventory. 2.18 you sell off that inventory, and that's remaining. Now you purchase more at 2.3. When you purchase more at 2.3, what do you do? 115 is there, 87 is there. 87 plus 117, 202, and the units are 90. You divide these two, you get 2.24. And at the end of the day, at 2.24, you are going to sell it. So when your inventory is there at 20, you just multiply it with 2.24. That's it. And you get the answer. I hope that I'm not doing it right. Yes, it is right. So that's how you do this inventory valuation. I hope that you guys can go ahead and do that. I have explained you the outline structure of it. Now coming up towards accounting for the material inventory account. So see here, what happens is you cannot just record those items directly in your account. Okay, sometimes there is some opening, closing, some changes are happening across the calendar. So what happens is you take all those changes and all these records in this control account, material inventory account, or you also can call it material control account. Okay, so what happens, you debit with the opening balance, whatever the work in progress is there, whatever the returns are there, whatever the payables are there, you record it in this particular account. And at the end of the day, when you have that balance goes on directly to the material account. Okay, see, this is material inventory account. You take account of small things which are there in bulk. Some raw materials will be there, you take that account normally as a normal account which we take in, what comes in, what goes out, in that manner. And then when this is balancing up, then you take it to the direct main inventories account. So you can see in here, debit reflects an increase, so what comes in, credit reflects are going out, what goes out. So what comes in, what goes out, that's a normal principle which you need to put in here. Okay, with that we have completed materials. Let's move forward towards labor. Okay, so now accounting for labor. Let's get started with this particular chapter, accounting for labor. See here, with the materials, we need to manage the material, the stock. Here we have to manage the labor, which is nothing but the turnover ratio of the labor. And also we have to manage how much payment we have to give to that particular labor, in what method we need to give them. If suppose there is any bonus calculated, then how much we need to calculate and give it to them. Moreover, are they working on their full capacity or not? These are the factors which we need to take into consideration. Like payroll department is just to calculate the gross wages and stuff, and then related towards the time. See, are you going to pay them based on how much time they have invested to work in here? Maybe it is an hourly base or daily base, based on the time which they have invested in this particular work. That's point number one. And then if suppose not in that way, see, if how many hours worked into the basic rate, overtime worked into the overtime premium rate. Otherwise, if suppose not that, what is this? Okay, time records according to the clock, or you have a clock register, you come in at this time, you go out at this time, this was the amount of break you've taken. This is one method of recording. The other method of recording is based on how much output you have produced, which is nothing but a piecework system, piecemeal system, which they call it. So the wages depends on how many units you produce. Like I'll give you a wage based on how many books you make. If you make 10 books, you get money for 10 books. Okay, or else you invest 10 hours here, you work for 10 hours, you get wages for 10 hours. That is the time related wage. So two types of wages in here. One is nothing but straight piecework. The number of units, you get a differential. The most widely used piecework system involve different piece rates, different levels of production. If you have different products to be produced, different ways, different wages for it. Okay. So these are some general questions about it. Let's move forward towards the incentive system, the bonus system. Okay. Now, premium bonus plans, the number one being premium bonus plan, if you can just see in here, the employee receives 50% of the time saved. So how much ever is the time saved, you need to calculate. And then first of all, understand time allowed by time taken divided by 2 into time rate. And then time taken by time allowed into time rate into time saved. You guys need to remember these formulas because these formulas are not going to come in your examination. The formula sheet which is there at the start of this material, those formulas are only going to come. These formulas are not going to come in the examination. Okay. Then measured day work, share of production. Okay. Anything which is extra. So see, understand this. Remember when you're calculating this overtime premium, remember that they are given a basic pay and then plus an overtime premium. So you need to calculate both. You don't just calculate the overtime premium and you'll be done there. That's some silly mistakes which you can do in the examination. Is this a problem? No, you guys can go ahead and do this for sure. Okay. Then direct and indirect labor. Direct labor is which makes that particular product directly attributable to the product you make it. That's the bonus payment for the direct labor. Sorry, bonus payments or whatever payment you make it to the direct labor. And those labor which are not directly attributable to the product, which do not work directly with the product, but just support you in that particular work, they would come under indirect labor. Okay. Then overtime premium. See, whenever you're making an overtime premium payment, you just see here $12 you're going to make him paid, but some portion is the basic pay and some portion is the overtime premium. So both you add it on and then give it for the extra time worked. Most of the times it's given, sometimes it's not, just they pay with the basic rate. It depends. And also understand this overtime premium, this amount is an indirect cost. Okay, that's an indirect cost. Make sure that you have that clarity with you. Moreover, with the revision of the syllabus, you'll get more clarity with it. Then accounting for labor cost, direct labor cost, indirect labor cost, you have different type of accounting for it. See, again, labor cost, you cannot put it all into the labor account directly. You need to make small accounts. That's nothing but labor control account, and then at the end put it to the labor account. I guess my voice has also gone down. What shall we do now? One thing which is more important, this is 100% going to come in your examination, 100% going to come in your examination, which is labor turnover. How many people are replacing, how many people are joining, how many people are leaving, divided by the average number of employees in 100. So that's the labor turnover. How many employees are leaving the organization, how many people are joining the organization. So this is a turnover happening. So if you have a high turnover, that more people are joining, more people are coming, joining, leaving, that's not good for the organization. Less number of people are leaving the organization, you're there in the organization for longer time, that gives a good non-financial measure for the organization. So if you just see in here, labor turnover rate is number of leavers who require replacement divided by average number of employees. How do you calculate average number of employees? Is nothing but starting year, what are the number of labors, end year, what is the number of labors, divided by 2, and then how many replacements you want, number of leavers, then divided by the average number of employees, you'll get an answer for it. Causes for it: poor remuneration, lack of proper staffing for the employees and stuff, that will lead to a low or a high labor turnover. Okay, low labor turnover is actually good for the organization. Then labor efficiency ratio, which is nothing but standard hours for actual output divided by the actual hours worked to produce that particular product. So how much you calculated, it should be paid for it, but how much is the hours which you should work for it, but how much you actually worked, that it is. Then idle time ratio is idle hours divided by the total hours, and then labor capacity, actual hours work to produce an output, and how much is your total budgeted hours. Are you working more than your budgeted hours or less than your budgeted hours? You're calculating it depending on your labor capacity ratio. Then labor production volume ratio, standard hours for actual output divided by the total budgeted hours. That's with the labor production volume ratio. So it's really, really simple. It's just you need to understand that what question is being asked in the examination and be ready for it. Understand this. You can get questions from theory, from practical questions, everywhere from these chapters. It's nowhere written, okay, labor, you're going to get practical questions only. No, nothing as such. You are going to get theoretical questions also. It depends on how you are ready to give these type of questions. It matters a lot because there are going to be mixed questions from it. Okay, so we have completed this chapter also. So I'm trying to give an overview type of a thing from these chapters. I'm not going in depth at all. I'm not solving these particular questions is because this is a revision session, and for all those problems solved and all, we can have another session for it. Then we'll see if it is required. I'm leaving up some easier problems to you guys so that you guys practice it on a regular basis and try getting good performance in your practice sessions itself. Whenever you do a practice session, make sure that you get maximum output out of it. Okay, so let's move forward towards the next overhead, accounting for overheads. Now, accounting for overheads, these are those costs which are directly attributable to the product, but they are not the material, they are not labor, but they are directly attributable to the product. So let's get started with it. Direct and indirect. Direct is nothing but directly identified and directly attributable to the product, and indirect is it cannot be directly identified and attributed towards the product. So it is used indirectly on that particular product. I'm telling, not talking about material, the complete product overall. Okay, so just see in production, manufacturing overheads, you see administration overhead, sales and distribution overhead, production, manufacturing. These are the overheads which are levied on it. Like production overheads for a factory, you can see heating of the factory, lighting the factory, renting the factory, assembly, machining, finishing. These all are overhead costs which are directly attributable to the product. You can say direct cost. See here, direct cost and indirect cost are going to play a major role in here for overheads because we are going to do the absorption of it. So number one type of costing is absorption costing. Now this absorption costing has nothing to do with the absorption which we are going to do later on. That's a bit different. See, absorption costing is a kind of costing in which you take all the cost in the product cost itself. So for that, you guys need to understand what is the product cost. Okay, what is the product cost and what are period cost. Okay, now what is product cost, what is period cost, that is there in the next chapter, not in this particular chapter. Okay, so let's just get started with the overhead allocation and stuff. Allocation and apportionment. See, IAS 2 is accounting for inventories. Okay, accounting for inventories, you can see in specifically excluded what are the abnormal amounts, wastages, these are not included, storage and stuff, selling cost, administrative overhead, these all come under the indirect cost. They do not come under the direct inventory cost. Okay, now coming up towards allocation and apportionment of these costs. Now what costs are getting allocated and apportioned? Let me just show it to you with an example. Okay, so you can see in here this particular example, LS Limited has two production cost centers, okay, and two production service cost centers. Okay, so the production cost centers, so the cost is directly attributable to the product, so that's a production cost. Service cost, it is not directly attributable to the product, that's why it is a service cost. But still, what you need to do is nothing but you should take that service cost which the cost is levied and put it towards the production cost, so that the total production cost when we get, we can easily put it towards the product. Okay, so if you just see in here in this example, there is a production cost center, but they have not said those details as such, but they have given these all are the indirect cost. Is there a problem here? These all are the indirect cost which is there. So you need to apportion this indirect cost towards these assembly and finishing. That's what they are saying. So for that, what we need to do here, what's happening with this pen? Okay, no problem. Let's move forward. So you can see here Indirect materials, or you can see all these costs which are there in here. Let me just put this aside. Okay, you can see here that indirect materials is there. You need to apportion this indirect materials to all. You need to apportion this rent to all. This electricity is to be apportioned to all, because these all are budgeted next period items. So here, if you see, indirect materials is already been apportioned. This 20,000 is already been apportioned. So what do we need to apportion? We need to apportion rent, electricity, machine depreciation, and indirect labor. Okay, indirect labor also is also apportioned. Okay, indirect labor is also apportioned. So what we need to apportion is rent, electricity, and machine depreciation. So how are we going to do that? So we have to do it based on cost drivers. So rent, what is the factor? Area, can it be? Yes, it can be. This kilowatt hours consumed can be for electricity. Machine value, it can be for machine depreciation. Then staff, direct labor hours and stuff, these are not relevant to us at all. Not relevant to us for this particular question. So area, square meters, rent is there. So 15,000 rent, I need to apportion it into 1:2 is to 0.5 is to 0.5. Or you can say, if this is 100%, I'll take it as 25%, 50%, and 12.5, 12.5%. I need to apportion it in this format. So how I would be doing it is nothing, is like this: 15,000 multiplied by 1,000 divided by 4,000. If I just do this, I'll get the answer. Then 15,000 multiplied by 2,000 divided by 4,000. Apportion it. Then 15,000 multiplied by 500 divided by 4,000. 500 divided by 4,000. Okay, that's how I get the answers for them all. And then kilowatt hours consumed, again you can see in here, electricity 10,000, it is 10,000 into 2,750 divided by 10,000. So directly only I'll get the answer. There's no calculation at all in it. Then machine depreciation, see 100,000 it is, so 5,000 here it is. I can just take 45%, 35%, 11%, and 9% of 5,000 and apportion it to assembly, finishing, maintenance, and canteen. This is simple apportionment only. Now comes our next problem. Next problem is really important, in which we do reapportionment of production service cost centers to the production cost centers. What we are doing? We are doing reapportionment of the service cost centers to the production cost centers. So first of all, we'll have this type of a question in front of us. Okay, direct reapportionment. We have assembly, finishing, maintenance, and canteen. So this maintenance and canteen, if you just see in here, they have said, okay, the total overheads apportioned to the production and service cost centers is as follows. The canteen feeds the staff, work, and a company in assembly and finishing. The number of employees of each cost center is this. So canteen is a service cost center. They have said it. And then you see the amount of time spent in maintenance cost. Maintenance cost is again a service cost center. So these two are service cost centers. What you need to do is take these costs, okay, take these costs and apportion them towards the production cost centers. So you apportion it towards, let me just erase this stuff. Okay, you take these costs and you apportion it towards this and that. Okay, you apportion it towards finishing department and you apportion it towards assembly department. Now in what proportion you need to apportion, that's the question which you have, and you have the methods for it. The first method being for it is the direct allocation method. So direct allocation method, if you just see in here, see they have given 60% is for the assembly and 40% for the finishing. Which one? Maintenance. So I'll just take this 18,600 multiplied by 60%. I'll give it towards assembly. Okay, I'll take 40% of it and I'll put it towards finishing. And then here, which is for the canteen, if you just see here, it is 18 and 30. Okay, so 18 by 48 and 30 by 48, I'll apportion it towards the assembly and finishing. 18 by 48 and 30 by 48. I'll just do that and it will be done for me. See, that's how they did it also. If you want to see it, you can pause it and watch it right now. You can go ahead with it. If you have the material, you can do it yourself. Then comes a step down method. Now in step down method, what happens? In step down method, what happens is you do it one by one. Okay. You do it one by one. First, you will do the maintenance department. Okay. First, you do the complete maintenance department towards assembly and maintenance here. And then next, what you'll do, you'll take the canteen department. See, first you take the maintenance department, you apportion it towards finishing, assembly, and canteen. Okay. You take maintenance cost and you apportion the maintenance cost towards assembly, finishing, and canteen. So the canteen amount is full here. Now, when the canteen amount has been added up with maintenance, what you do, you take this and you apportion it towards finishing and assembly. You don't go towards back towards maintenance in step down method. In reciprocal method, what happens is you go side by side, here by here by here, again and again. In this also, it is almost the same. Only see, the main purpose, what you're doing is you're allocating these service cost towards the production cost. That's it. Okay. So the workings which you guys can go through. And then we have our reciprocal method. In this reciprocal method, what you'll do is nothing but you'll make two equations. Okay. You'll make two equations out of this particular question itself. See here, so they have given direct question itself, direct amounts itself in total, that these are the amounts which are there at the end, and you have to just apply the reciprocal method. So what you do with this reciprocal method, you apportion in the sound is coming from outside. In reciprocal method, what happens is your canteen department is giving service to maintenance, and maintenance department is also giving service to canteen. So this, there is service provided to each other's service departments also. So what you do here is you understand, okay, how much is to be apportioned to this, how much is apportioned to be that, and who is giving how much to what service. You calculate it. And this method, you can directly go ahead like this. Okay, you provide 10% to this. Okay, you provide, okay, this much percentage to that. You can do it as you have done it in the step down method, but only in step down method, what you do one by one. Here you do both together itself. Okay, in reciprocal method. Much easier way of doing this is, one by one, you remove the cost of canteen, apportion it to these three. You remove the cost of maintenance, you apportion it to these three. You remove the cost of canteen, you apportion it to these three. So it goes on and on until it becomes 0, 0. Okay, that's point number one. That's one particular method. There is another method also, which is the equation method. Okay, equation method, which you guys can use it also. So what happens is, see, you've understood that who has to apportion each other department in how much percentage. With that, you create two equation, like M is equals to 18,000 maintenance. The maintenance cost is equal to 18,000 plus 600, 18,600 plus 20% of canteen, and canteen is 6,600 plus 10% of maintenance. You have these equations. Substitute one equation into the other. Okay, substitute one equation into the other. So you have this M, when the C is there, you equal this particular amount. When you have made these two equations, substitute this equation and then this simplify these two equations, you will get the amount of maintenance, you'll get the amount of canteen. And once you get these amounts, then apportion it towards the production departments, the assembly and assembly and finishing department. Apportion it towards them. Simple. But see, these things, I'm just saying it to you guys easily. You guys need to apply these stuff. You guys need to practice these problems. You guys need to practice these problems. It should be as many times as you can. Okay. Then basis of absorption of overheads, they have a particular, basis of absorption of you calculating an overhead budgeted rate, and then on that basis you have that calculation of absorbing the overheads. Now when you are absorbing overheads, absorption of overhead means that before the actual overheads have incurred, you are calculating it on a predetermined rate. Before the actual overheads have been calculated, you are calculating it on a predetermined overhead rate, and that is the estimation which you are doing. Now when you have this estimation, what you need to do when you have this estimation, you need to check it with the actuals that whether your estimation is right or not. You need to check it with what? Your actuals that your estimates is right or not. So now when you have these estimates, you calculated these estimates based on your overhead absorption rate, your budgeted overhead absorption rate. These budgeted overhead absorption rate is done. Now you need to check it with the actual overheads. When you check it with the actual overheads, either your overheads are under absorbed or over absorbed. Okay. Suppose you had to record the overheads. Suppose you budgeted it as 20,000, and on the day when overheads are actually absorbed, it is 18,000. So what has happened here? Overheads have over absorbed here. What you need to do? Reduce it. Suppose the other way around, overheads are more absorbed. Suppose the overheads which you had calculated is 18,000 and actual happened was 20,000. What happened? Overhead is under absorbed. So you need to absorb more 2,000. Okay. I hope you guys are getting the difference between the two. Here it is. Where is that under or over absorption? So here they are calculating the overhead absorption rate. This is the budgeted rate which you are calculating. And how do you calculate the budgeted rate of overhead? Here's the formula: budgeted production overhead divided by the budgeted total of absorption basis. Okay. Now coming up towards the under or over absorption of overheads, really important for your examination. First, calculate the overhead budgeted rate, then the actual rate. Compare the two. You'll find out whether it is under or over absorbed. If it is under absorbed, absorb something more. If it is over absorbed, reduce that amount. As simple as that. Okay. Here you would be asked questions that, okay, and under or over absorbed, what will be the effect of this in the profit and loss account? These are the things, these are the type of questions which can come, and you guys need to be ready for these type of questions. Okay. With under and over absorption, then we are left over with the main, not main actually, this is the end of overheads. This is a graph which can be shown that, okay, this is the amount over absorbed, this is the low under absorbed and stuff. You can understand that. Accounting for production overheads. Now, if you see in here, accounting for production overheads or accounting for inventory control, materials control, and also the labor control, we did two accounts. Here also goes the same. First, what you need to do, take this indirect expenses, labor and stuff, and go towards the work in progress. This is production overheads, and then move it forward towards the over and under absorption. Now, this over and under absorption is there. Then what is the effect on the statement of profit and loss account? So the question which I just said you, that you can expect questions from profit and loss account, that what is the effect of this on the P&L account? So here it is. We have come towards an overview end of the 5 chapters which we started today. It was a long session with a lot of breaks and stuff. We have not done any major questions from it. We have just touched it above, but I also have the question and answers also in the previous sessions which I have taken, the regular class which I have taken. In that, the answers are there recorded. If you guys are interested for that also, then you guys need to join into those sessions or join into these this join program of the YouTube channel to get that answers for it. I hope that this session has helped you a lot for preparation. This is the first session in which we have chosen what? Chapter 1, 4, 5, 6, 7. So these are the 5 chapters which we have done. In the next session, we will be doing 4 chapters, and then 4 chapters, then 4, and then 4, and then we get over with it. So in total, there are 4 sessions for management accounting. I hope that this is going to be helpful for you and you get maximum value from it. If you're new to this channel, make sure that you share this video, subscribe to our channel, like this video, and keep supporting us. Thank you very much.